It's a pleasure to be here today to start the session with a brief review, here we are, of the global and regional outlook and some implications for the tourism industry. I gather time's short, so I'm going to dive straight in. See if I get this right. We appear to have a technical malfunction. Try that one. Yes. Thank you. So starting briefly with the global outlook. In essence, we don't think that the world is heading towards a global recession, although it will slow very sharply. I mean, growth this year will come in at 2.3% if we're lucky, and we're looking at the same figure for next year. So growth is pretty weak, but I think what's important is that strong household and corporate balance sheets are helping the global economy weather the exceptionally high interest rates we've got and the continuing geopolitical tensions around the world. And I think this is a key factor which has actually been supporting the strong performance that we've seen in the tourism sector this year. But that said, on a macro level, the economy is weak. Europe and the US have been flirting with recession, although I think they've been much more resilient than we expected. I think this, as we can see on the chart here, we've revised our forecast for the US and Europe quite substantially upwards as the year has progressed. Nonetheless, growth is weak, and much of the global impetus this year is coming from Asia. However, in contrast to the US and Europe, the recovery that was expected in China as they opened up their economy has actually been much weaker than expected. So we've been revising down our growth projections in China, and I think it's worrying that the authorities appear to be struggling to maintain growth there. And there are a number of issues, particularly in the property sector and the emergence of defaults, which are causing concerns. So more generally, the global economy continues to face headwinds and scars from the war in Ukraine, particularly the enduring impact on commodity supplies and prices. And these are the things that have really contributed to the surge in inflation that we've seen and the resultant sharp hike in interest rates as central banks have been grappling to keep that inflation under control. So sadly, our baseline assumption is that the war in Ukraine will continue to drag through 2024. So this will keep sanctions on Russia in place. It will cut Russia off from Western countries. And it's contributing to the global geopolitical fragmentation that we're seeing, splitting countries that support Russia and those that don't. And I think this fragmentation will continue to be a headwind to growth. So this map just shows a bit more clearly some of our projected 2024 growth rates. As you can see, the US and Europe are going to be growing very slowly. I mean, less than 1%. And I think there is still a risk that they could tip into recession. Asia will remain the fastest growing region, although the pace of growth will also slow there, with China notably slipping below 5%. And we expect Chinese growth actually will continue to slow over the next 5 years to under 4%. Even so, we forecast that developing countries and emerging markets will contribute the most to global growth over the next 5 years or so, helped in particular by stronger contributions from South Asia and Southeast Asia. And that includes India, which I understand is a key source of tourism for the region, particularly here in the UAE. Now, looking at inflation, it does now appear to be on the turn, but despite very high interest rates, it is only receding, quite gradually. Our forecast for a global rate is it to drop from about 9% last year on average to 7% this year and to 5% in 2024. And this is still obviously substantially higher than sort of pre-pandemic levels. Now, the disinflation is being driven by an easing of supply chain disruptions, lower commodity prices from the peaks that we saw last year, and more recently, the impact of higher interest rates and tighter monetary policy. Now, sustained high inflation is not good for consumer demand, nor business investment, and the related sharp increase in interest rates is clearly raising debt servicing costs. And earlier this year actually rocked the financial markets quite significantly. I think we need to recall that we had large bank failures in Europe and the US earlier this year. So I think there is a risk that disinflation that we're projecting may take a bit longer than expected, and that will keep interest rates higher for longer, and that potentially has the risk of dragging on our already relatively muted growth forecast for the globe. That said, while inflation is proving stubborn, we do expect major central banks will now stop raising rates. The Fed perhaps left in one more rate this year at its last meeting, which caused a bit of disruption in the financial markets. But it's our view that they will pause and they won't start cutting interest rates until the second half of 2024. So I think we're looking at a period of another 10 months of exceptionally high interest rates, with a cut only happening late in the second half of 2024. Shall I allow some settling? Okay. As I mentioned earlier, supply chain disruptions have been one of the key drivers of higher inflation, and this has come from both the war in Ukraine as well as the unprecedented lockdowns and then reopenings of economies due to the pandemic. And I think we need to be conscious that this continues to have caused major disruptions around the world, including in terms of labor supply. Fortunately, we are seeing a significant easing of these strains. This is most clearly reflected in falling freight costs as firms have caught up with the backlog. And this can be seen in this chart, which effectively is comprising an index of numerous freight costs. On top of transit costs, we're also seeing an easing in many commodity prices from their highs last year, including for energy, fertilizers, and food. But I think we need to recognize geopolitics remains a big risk. Already, we're seeing grain supply disruptions reemerge as Russia has backed out of the Black Sea grain deal. And in addition, we're seeing continued trade tensions between the US and China. And this is increasingly pushing businesses to review how they can minimize supply chain disruptions and risks. And I think this is leading to a sort of regionalization of supply chains and close or friend-shoring. This is an early trend. It's in its infancy, but I think we are going to expect to see more shifts as the years progress. One of the most notable will be companies looking to reduce their supply chain exposure risk to China from possible US measures, and also to take advantage of some of the incentives that the US is providing through its Inflation Reduction Act, which provides large subsidies for companies in certain sectors to come and relocate back to the US. Anyway, as this graphic suggests, survey results show that Southeast Asia, Mexico, India, and the US are some of the top relocation destinations that companies are looking at. Now, As I mentioned at the start, commodity price pressures have been a key driver of global inflation. We do now expect them to ease, both as supply chain disruptions get resolved and in response to weaker growth. However, prices will remain high in level terms. We also have the pressures from the green transition that will ensure that prices for certain metals remain high. And it's notable that food prices, despite coming down, are still quite sticky. Looking at oil, obviously it's a key commodity for the region. These are back over $90 a barrel due to, should we call it, the managed supply disruptions via OPEC production cuts. And so this will ensure that Brent will obviously average over $80 a barrel this year, and I think this needs to be revised over $80 next year. We don't think prices will be higher than that, mainly because the global economy will remain weak, and higher oil pressures may accentuate that weakness, and if it affects inflation and central banks' policies, we could see rates higher for longer. So in broad summary, the benign environment of 2018 is now gone. Geopolitics is imposing higher costs and playing a bigger role in the global economy, particularly US-China strains, the war in Ukraine. I think the era of ultra-low interest rates is also now gone, and this has implications for funding for companies and for financial markets. The global team have identified these top 10 risks. There's a white paper publicly available with the details, and I won't go through them all, but I'd just like to point out that 5 of the identified risks are related to geopolitical issues, including conflicts and obviously tensions between the US and China. I'd also just like to point out that there is a lingering risk of a crisis in the financial sector, which could potentially trigger a global recession. Perhaps overarching all of those, and of relevance to the tourism industry, are the increasing risks associated with climate change. As Jonathan mentioned, this year has been the hottest year on record, and over time, temperature changes will likely prompt some sort of shift in tourism patterns. Already this has been discussed in Europe as traditional summer holidays in the Med become unbearably hot. And this may be an area that the GCC can benefit from, given its winter sun offering. Let me move on. Turning to the GCC, I think headline growth will slow this year, but this is mainly a reflection of the oil production declines in line with OPEC cuts to support prices. This will be most notable in Saudi, which is bearing the brunt of the cuts, and growth there will likely stagnate. It may even print a negative rate for this year. But that being said, oil prices above $80 a barrel will provide a comfortable buffer, and we expect liquidity in the region to remain very healthy. This will support sustained high investment spending aimed at pushing forward regional diversification agendas, and particularly in the wealthier states like here in the UAE, Qatar, and Saudi. And governments here will also continue to pursue regulatory reforms aimed at improving the business environment. So all of this will help sustain non-oil growth at around 4% a year. So while overall growth in the GCC on average may slip below 3%, the non-oil sector will remain relatively robust. I'll just point out that the sort of acceleration in the average GCC growth rate in the chart for 26-7 largely reflects the coming online of new gas production in Qatar. Inflation in the GCC is not yet a problem. Let me move on because time is short, and I think I'll just focus on the tourism sector directly. As you know, obviously, tourism sector, hospitality took a catastrophic hit during the pandemic. Now, there has been an incomplete rebound last year, but this year we are seeing a very healthy surge with improvement in most regions. And I think almost all will likely see a full recovery to pre-pandemic levels by the end of this year or into 2024. Certainly, there's been a much more upbeat outlook for this year. We have been including all the reopenings, including finally China, and we're seeing big promotional campaigns, pent-up demand, and the return of in-person corporate events, such as this one. I think certainly there are still challenges. from higher operating and financing costs, from the higher interest rates I was talking about. And I think affordability issues will come into play, particularly for the less well-off tourists as we move into next year. But I think it's noticeable that the recovery has been strongest in the Middle East. I mean, this chart here, the green bar on the right, basically showing that visitor arrivals in the broader Middle East region were back above pre-pandemic levels in the first quarter. A number of reasons. We obviously had the Qatar World Cup, an easing of visa and social restrictions, and gains in established markets like here in the UAE. I'm going to move through quite quickly because of time. Supporting this recovery in the Middle East region is that we actually have seen a rebound in flights and air passenger activity. This is data from IATA, and I can see, if you can see the Middle East there, the air passenger traffic is expected to exceed pre-pandemic levels this year and actually be the fastest growing region in the world next year. Now, I know it's not the GCC, but I have this up-to-date data, and I want to put up this chart for North Africa. Basically, these key markets showing that arrivals and revenues are effectively on track for new records this year, although sadly, unfortunately, the earthquake in Morocco will derail that there. It's hard to see, but the bars on the far right are just comparing the year-to-date data for this year with a similar period last year. Just to put some numbers on it, in Morocco, visitor arrivals were up 130% in the year to May. In Tunisia, they were up 100%. In Egypt, over 30%. And revenues are tracking these trends. Now, all three of these countries are also looking to invest in growing their tourism sectors. But I think we have to be aware that, given the earlier discussion I have of the global outlook, I think that the prospects for 2024 are a little bit more uncertain. The backed-up demand from the earlier pandemic restrictions, which appears to be driving much of this year's gains, at least perhaps in North Africa, may now almost be spent. Consumer finances have come under increasing pressure from the cost of living, higher interest rates, elevated flight costs, and slowing economic growth, especially in key European markets. So I suspect that the outlook for next year may be a little softer than we experienced this year. Now, unfortunately, I don't have the same kind of figures for the GCC region, but the figures I have seen clearly indicate that there's a similar trend in train here with visitor arrivals and revenues heading for record numbers. And as has been discussed by the excellencies, the sector is an increasingly important part of most countries' diversification agendas. And as this chart shows, there are sort of really quite ambitious plans to grow visitor numbers further. As to the outlook, I think next year may be a bit tougher, as I mentioned. As the global economy remains weak, we have the lagged impact of the higher interest rates impacting consumers, many of whom may now have spent those pent-up savings when they couldn't travel. And this is likely to be true, particularly, I think, of European and US consumers. This won't affect the high-end market, but I think in the mid-market, the pinch is going to begin to be felt. And I think, unfortunately, in China, consumers there are worried about their savings, much of which is tied up in the property sector, which is undergoing a bit of a crisis. So we probably won't see that sort of resurgent surge in Chinese visitors that perhaps we were hoping for. On a more positive note, India should remain a growing source of visitors, particularly to the Gulf region. And the Gulf region itself will be a key source of tourist demand, including potentially more visitors from Iran, but that's a much broader subject that I don't have time to discuss. But I think it has to be recognized that the countries are now facing an increasingly competitive landscape. And this will continue to push governments into making big changes. Already we've seen this widespread easing of visa restrictions, an increasing focus on sport to attract visitors, a more liberal approach to personal behaviors, including drinking alcohol. And as I understand that, we now have potentially the prospect of allowing gambling here in the UAE. Early days yet, but as is evident from places like Las Vegas and Macau, that does have the potential to pull in even more tourists. Now, in sum, I believe the medium-term prospects for the tourism sector in the Gulf here are actually very healthy. We might have a soft patch certainly next year, but I also think it needs to be recognized that competition for visitors will only get more intense, and this will force providers and governments to continually expand and improve their offering, something which I'm sure everyone, all the participants here are actively engaged in, and this conference is allowing people to discuss those issues. I think I've managed to fill my shortened allotted time, and I do have a flight to catch, so I will end there. Thank you.